right, Richard Harris is joining us, Chief Executive Officer of Port Shelter Investment Management. Richard, good to have you with us here. Thanks very much for your time. You know, we had a lot of U.S. banks which reported numbers and pretty much solid numbers, right? So this should once again allay any fears that the banking sector, which is at the heart of the financial sector in any country, is in any trouble at all. If that is true, then will the market have to reprice their own expectations of what the Fed will do because they don't have to worry about banks and the financial sector in that sense?
Well, I think what's happening with the banks, as with all of these numbers, is that, we're looking at through the rearview mirror a month or two back. What we've seen is obviously yields rise. Banks haven't really raised their deposit rates, so obviously their margins are going to widen. And you've seen, especially with some of the major U.S. banks, that earnings look pretty good. And also don't forget that you've had a lot of deposits flooding out of smaller banks into the bigger banks. So the bigger banks have done well as a result of that. I think we need to be cautious about the banking sector. It's the area of the market where you first see non-performing loans and stress happening. Against that, of course, we now have the situation where clearly there's some kind of put going in. Authorities, not just in the US and around the world, as we've seen with Credit Suisse, are going to support banks. They're not going to let banks fail because it's people like you and I who get affected by that. So banks are in a rather special position. So I think we are in a situation where, yes, we may see more runs on banks. We may well not see them because people know the authorities are going to support them and stand behind them. But I don't think the bank results actually foresee any real improvement in the markets.
Okay, that's about the banks. But what about the overall equity markets? I mean, the Indian market has had a fairly smooth run. We've seen a recovery of around 5.5% from the lows that we saw in the month of March. Do you think that pullback is something that can continue? I ask because we could be heading into a global recession as well. What happens then?
Well, I think that's right. I see this as being relatively short term. I saw one of your correspondents a little bit earlier was maybe a little bit more bullish than myself. But I am cautious. I think we're in a period of volatility. Yes, the market will go up 5%, but it'll probably also go down 5%. If we see recession, that's going to be negative, but we're probably going to see it first in the US and Europe, and maybe rather later, say somewhere like India is likely to be affected by orders. But I think you're going to be pretty brave, I think, to dive into the market unless you're an out-and-out short-term trader.
Hi, Richard. Good morning. How many more rate hikes are you factoring in from the Fed, in 2023 itself?
Well, over the weekend, we've had words from both Jamie Dimon, head of JP Morgan, and Larry Fink, who's head of BlackRock. Now, those guys look over trillions of dollars of assets. So you have to look at them pretty seriously. They both think interest rates are going to go up. It's fairly clear that certainly where I'm sitting, if I go into the supermarket and just what we're looking from data, that inflation is here. It's very sticky. It hasn't yet got through to the major population, except maybe in utility bills and things like that. And I think we're just going to get a continuation of the wage spiral because people have to have more money to pay their costs. Then companies are going to be concerned because their costs are higher. The big metric to look out for, I think, in the West is unemployment rates and where labor is actually going to go.
But just, Richard, just as you said that bank earnings were reflective of what has already happened, right? One can argue, many actually do argue that the CPI numbers are also exactly that. They're telling you what has already happened, not what is likely to happen. So would you want to respond to that?
Well, of course, that's the worry. And what we have at the moment is, we saw inflation start to go up because of COVID. Inflation was high last year. We've now got the base effect where it appears that inflation is coming down, on a year-by-year basis. But don't forget that in many Western markets, they're coming down to 5%. In Europe, they're coming down to 7, 8, 9% from higher levels. But those figures are substantially more than they were, say, 2 years ago. So there's going to be some catch up in the system. And I think what we have to be very careful is that all of these cycles, the interest rate cycle, the inflation cycle, the employment cycle, the consumer cycle, the economic growth cycle, they're all moving in different directions at the moment. And that's increasing the complexity for analysts to actually see what's going on.
So where do you put your money then? That's the big million-dollar question, right? If you have money to spare in a market like this, if you're cautious on India, you say that this is not the best time to be investing. Do you stick to cash? Do you put your money in alternate assets like debt or even, perhaps real estate? What's the asset allocation strategy now?
Well, as an investor, you can't run, you can't hide. You've got to be in something. I still think selective equities look pretty good. Things like consumer durables. I still like areas like the tech. I mean, if you're looking as a foreign investor looking at India, I think you have to see, what does the economy really do quite well? Things like generic drugs. I know you're talking about Infosys, but these companies are going to be hit with the J curve. But eventually, foreigners are going to be looking at those kind of counters because they're the counters, I feel like, that represent India to foreigners. So I think certainly as an overseas investor, you need to look at those kind of things. What makes up the country if you're going to invest there. And I think you have to also maybe have some cash and maybe even a little bit of gold in your back pocket, because this is the environment where, it's volatile. Things may not go up, things may well go down, and cash can be king.
All right. Very quickly, Richard, before we let you go, toss-up between India and China. I think the last time we chatted, you were more inclined toward China. How do things shape up out here?
Yes, well, I think what's happened, not only to me, but to most people looking at China, is we've been really very surprised by the fact that they haven't seen the significant rebound that we actually saw in the West and in other markets too, as the COVID restrictions came off. It's been much more muted. I think one of the reasons for that is people over the space of maybe 2.5 years have got very, very cautious. They don't want to dive in. They don't want to invest. They don't want to spend because they have been stopped so many times. So I think that there is a reluctance there. I think China will continue to recover and the figures will continue to do better and better, but at a much, much slower pace than was expected from around the rest of the world. So on that basis, you're probably back to maybe a more neutral China look if you're looking between the two, but still possibly favoring China for that little bit of extra upside.
Okay, possibly favoring China. Got that. I mean, we don't like it that much, but it is what it is, right? Thanks a lot for joining us.
It's all cycles.
Absolutely. Market cycles. No one can help it. Thanks a lot for...
And it's good to see Richard on the camera, Richard. We usually have you on a phono placard, so this is much better.
And I have to put my tie on as well.
Sorry, I missed that.
I had to put the tie on.
I have to put my tie on too.
Is that your home, Richard?
Absolutely, yeah.
Okay.
Yeah.
Some of us are still lucky to work from home, right?
I've got to scrub up for you guys if I'm on camera.
Sorry, I didn't get that.
I have to scrub up for you guys. If I'm on camera.
Yeah, absolutely. You have to. I mean, some of us are still lucky to work from home, right? So that's a good thing.
Yeah.
Anyway, we'll speak to you again very soon. Thanks a lot for joining us on CNBC-TV18. Okay, so that's Port Shelter Investments talking about how they're still a bit cautious on the markets, and this is perhaps not a great time to be investing. There could be a period of volatility. Let's slip into a quick break, though. Lots of stocks to talk about. Infosys, of course, top of mind. Our entire research team will be joining in just a bit.